If there is a 40-year-old watching this video right now, how much Bitcoin does he need to retire ASAP?
The simple answer is 6.15 BTC, but the real answer is a little bit more complex than that. Most people don't even have this framework in their mind that this is even possible. This path is available to almost everybody. It sounds kind of crazy, but the math is the math. I was extremely intent on moving past this phase of my life where I was chained to a desk. If I was starting from scratch, I would be 100% allocated to Bitcoin. It's 4 years of intense saving. Those early years of stacking are so impactful. Somebody who is saving a whole lot more but starting at age 35 will end up way less wealthy than somebody who is investing a whole lot less but doing so with an extra 10 to 15 years of compounding. You can never have enough Bitcoin.
Most Bitcoiners know how to stack. Far fewer know when they've stacked enough. Welcome back to the Bitcoin News Channel. I'm your host, Rob Wallace. Share this video with one person who's trying to build a future with Bitcoin. Today, I'm joined by Trey sellers of Unchained and FireBTC. It's about freedom. Freedom from the commute, freedom from your boss, freedom to spend your time the way that you choose. In this conversation, we break down the retirement math that Wall Street uses and whether a 4-year stacking sprint could put ordinary people on a path to financial independence decades earlier than they thought possible. If you've ever wondered just how much Bitcoin is enough, this interview is for you. All right, hello. Today we are joined by Trey Sellers. Sir, how are you doing today?
I'm doing great, Rob, man. So good to see you again.
Yes,
I think
absolutely.
last time we saw each other, we were in Vegas, right? We were hanging out at your little makeshift studio on the expo hall floor.
That we were. We were live in Vegas commenting on the vibes, how things were going, the vibes. And we talked about fire and retirement, your specialty. And so I wanted to get you on the show because on YouTube, when it comes to Bitcoin, you'll always see all you need is X amount of Bitcoin to retire. Yeah. So I want to put you on the spot. People clicked on this video to hear from the man himself. If there is a 40-year-old watching this video right now, how much Bitcoin does he need to retire ASAP?
A 4-year-old to retire
40,
ASAP. 40. A 40-year-old. A 40-year-old. I think the answer is always and everywhere 6.15 BTC, which is the number that I threw out there on stage on the panel that I was on. And it's a meme that goes back years that nobody laughed at, unfortunately, which I guess tells you how long I've been around Bitcoin and just how much the culture has changed. That's no longer a good meme, but I think it's a good meme. And it's actually not maybe that far off from the truth. It obviously depends on what you are trying to do with your goals in your life. And I always start this question with, okay, you need to tell me how much do you spend? What kind of like timeline is it that you're working on? And what is your asset mix? Do you have other assets that you haven't pushed into Bitcoin? Because if you do, it's going to mean that you need a lower Bitcoin number, assuming that you're committed to that allocation, because you can give the Bitcoin a little bit more of a runway to accumulate value over time while you sell down those other assets first. And so, most people are not 100% allocated to Bitcoin. I'm not. I've got a very strong allocation to Bitcoin, but I have a portfolio of stocks that I've owned for years and years that I just never sold and moved into Bitcoin, despite wanting to do so. That's a whole different thread we could maybe pull on. But if you have a mixed portfolio, let's just keep it simple, of stocks and Bitcoin, two liquid assets that you can draw down in retirement or over a certain period of time, why would you sell the better asset first? You might as well structure your withdrawals in a way that gives the better asset more time to run and compound. And in order to do that, you would sell down the stocks first. So I read a lot about this in the newsletter. Withdrawal orders, how much Bitcoin do you need to retire? I've got a really cool tool out there, which we can get into what all the functionality is in that tool, that can help people to answer this question based on their inputs and their conception of what the Bitcoin price is going to do and what the inflation rate is going to be and all of these different variables. So the simple answer is 6.15 BTC, but the real answer is a little bit more complex than that.
Understood. So you have a newsletter, a relatively new YouTube channel where you talk about this all the time. FireBTC, financial independence, retire early. It's
Yes,
been
sir.
a phenomenon for the last 30 years. People have really dived into this movement, tried to figure out a way to earn as much as they can in their younger years so that they are free to do what they want later on. So let's start from the beginning and let's talk about the regular retirement math. In terms of retirement for millennials, people in their 30s, 40s, 50s, what is a prescribed number that a financial institution like your old employer, Goldman Sachs, would tell to their clients?
Well, I'm not going to speak to Goldman Sachs. I'll tell you where I start. And that is this kind of age old rule called the 4% rule. And it was built on a research effort back in the 90s called the Trinity Study. And what the study did was look at the historical performance of a 50-50 mix of stocks and bonds over about 130 year period, some very long period of time. And the question that it ultimately answered was, given that historical performance and expecting that historical performance to continue, what is a safe withdrawal rate for somebody to fund a retirement over a 30-year time horizon? So if you are in kind of the traditional way of approaching a career and then moving into retirement, you go to school, you graduate, you get a job, you work for 30 years or whatever, 40 years most of the time, you get to age 60 or 65, and then you stop working and you need to fund your lifestyle over another 30-year period before you die. And this approach, the ultimate conclusion was, if you have this 50-50 stock and bond portfolio and you assume this historical rate of return, which is about 10% for the S&P on average over long periods of time, the real rate after you factor in inflation is more like 7 to 8%. And bonds is obviously less than that. But what the conclusion of the study was is that for 95% of the historical back tests that they did, if you withdraw 4% of your portfolio from the time that you start retirement over a 30-year time horizon, you have enough money to cover your expenses as long as your portfolio is large enough where that 4% rule maps to your expenses. So this is why I said it all starts from what is your lifestyle and what are you spending your money on during that time period where you don't have any income, right? So we can kind of control for all of these different variables and make it very simple and say, when I retire, I've got some portfolio that I'm going to start drawing down from. If it is large enough where I can cover my expenses by withdrawing 4% per year perpetually, adjusted for inflation, then I've reached it. I've reached financial independence. I no longer need an income because I can I can replace that income with these drawdowns. I can create income by selling down my portfolio. And it just so happens to be conservative enough that it's going to last me at least 30 years. In most of those historical back tests, it actually lasted much longer than that, to the effect that you end up with way more than what you started with. There's only that small number of samples where if you start withdrawing at the exact wrong time, right before the 2008 financial crisis or right before the Great Depression starts or something like that, that you might risk running out of money. That also assumes that you're not actually flexible enough in your approach, that you don't have some type of reactive mechanism in your life to be able to adjust. It's just like a mechanical rule. Hey, I'm withdrawing 4% no matter what. I'm never going to pursue any other type of income. I'm never going to adjust this spending that I do in response to the market and the way that things are working. It's a simplified way to think about, what should I be going for? What should I be aiming at to reach a level where I can feel very confident that I am financially independent, that I can tell my boss who I don't like to go pound sand, that I can cut that commute completely out of my life that's making you miserable and giving you road rage every single day. When you reach that number, you can feel very, very confident that the assets that you have built for yourself are going to be able to sustain you through that long time period. So that's the general overview of what the 4% rule aims to solve and is a great shorthand for. And Bitcoin introduces a very interesting dynamic in this, because our expectation, you and me and a lot of other people, is that it's going to grow a lot faster than that 10% per year that I quoted for the S&P 500. So we can talk about what that might imply, but that's the basic framework that I work from as a starting point for how much do you need to reach financial independence.
And so you put out some numbers in your work. You say 25x annual expenses is what you should go for, right? So if you're spending 100 grand a year, you want to have a nest egg of $2.5 million.
And that is the inverse of that 4% rule. So if you take your expenses and divide by 4%, it's the same as if you take those expenses and multiply by 25x. So maybe a little easier mental math for a lot of people is to just multiply by 25 times your expenses.
But the idea is, with the 4% rule, you would at 90, if you retired at 60 and lived until 90, you would still have a nest egg that big at the end of 2.5 million. That's the idea. Like you're not drawing it down to zero.
In most cases, obviously the market moves a lot over that time period. There's a lot of different variables that are at play that are impossible, absolutely impossible to predict. Mm-hmm. This is a conservative approach to ensure that you've got the best possible chance for having enough money to last you through that 30-year period. In some cases, you might die with zero because you've sold it all down. It's been like kind of poor long-term market returns. Maybe you started spending more than what you had planned for or something like that. In most of those historical cases, though, according to this Trinity study, you ended up with far more than what you actually needed. And that's because, if you do the quick, very simple math, there's about a 6% delta between what you're withdrawing from a nominal perspective versus what the S&P 500 is giving you in terms of historical returns. If your returns and your withdrawals are perfectly linear, then you've got an extra 6% every year that you're accumulating, essentially. Mm-hmm. That's not at all how the markets work, as we all know. But it is an interesting thought experiment to just say, this is the reason that a lot of people, even though they're withdrawing and selling down 4% of their portfolio every single year, they still end up far wealthier by the time that they are actually passing away and then passing that wealth on to their family.
So let's talk about the reality of the situation, though. 2.5 million is a great goal to have, but I think I heard you say that the average 401k is around 230,000, right? A tenth of that. So what is the state of retirement in America for people that still have a runway to retire, say in their 30s and 40s?
So this is where the retire early piece of FIRE actually comes into play, right? So we talked about financial independence and kind of how to define what that looks like, but we didn't cover the retire early piece of this. Before anybody kind of accuses me of thinking that everybody wants to retire and whatever, that's not the emphasis that I put on this. I do put the emphasis on financial independence. The early part is a very strong focus of mine, is that I want to reach this number, and I want my readers to reach this number for themselves as early as possible. And what that does is open up the possibility of retirement, but also the possibility of working on passion projects, traveling the world, doing things that they actually want to do with their time instead of going and sitting in a cubicle from 9 to 5, 40 hours a week. So when we talk about financial independence, this retire early piece of FIRE is really like the goal of this movement is, how can I accelerate my timeline to hitting that financial independence number so that I'm opening up this optionality? The way that you need to do this, the way that you need to approach this, is to focus very intently on making sure that your expenses are as low as they can reasonably be, while still giving you the types of like focus and intentionality that you want in your life. I don't advocate for people to eat rice and beans and live in a cardboard box. Some people will choose to do that. There definitely are some people who are like way down on that spectrum. They take it extremely far on the expense side. But also over time, your income should grow. You develop new skills, there are new opportunities. And so what you're really focusing on for the time that you are working and pursuing something like this is to widen that gap between your income and your expenses as much as possible. And you take that savings and you push it into these liquid assets that can be used as your portfolio for funding your retirement. I'm a very strong advocate for Bitcoin. I think the stock market is a great place to do that as well, at least in the US. And so by doing that, you're building this engine that compounds over time. And if you focus very intently on doing that early in your career, earlier in life, or right now over the next 5 to 10 years, you can actually accelerate your path to financial independence much more than the people who you're referring to who have very little savings are actually able to do. And the reason I think they're not able to do that, and I don't want to hand wave away like economic hardship and these different types of things, but most people I think don't even have this framework in their mind that this is even possible. Most people are not necessarily financially literate from a personal finance standpoint, so that they would know that they need to focus very intently on their expenses, especially early on as they're trying to build some wealth. They're just not focused on putting together a framework or a plan for themselves that would allow for this. And that's why people end up with not a whole lot saved. Again, not trying to like downplay different hardships that people have, but I'm pretty optimistic guy. Like I think there's tons and tons of opportunity if you are aware that that opportunity exists and you have a little bit of focus and gumption to actually go out and achieve this path that is pretty available to almost everybody, I think.
And we're going to get into how Bitcoin changes the equation for retirement. But before we do that, there's a silent killer out there for all of these plans, and that's inflation, right? And it is stated at 2 to 3%, but in reality, the money supply is going up by 7%. And so we are seeing this inflation creep all over in every part of our lives, whether it's food or housing or education. How do you factor in the real rate of inflation compared to the government numbers, the CPI?
The real rate of inflation is different for everybody. Everybody has a different set of things that they spend money on, and therefore the basket of those goods and services that you spend money on, that I spend money on, that my neighbor spends money on is different. It's unique. And so you actually do have a lot of control over this. You have a spectrum of control over the things that you need to be funding for sure. But I think it's too easy of a shorthand to say the government's stating inflation is 3%, it's really 7%, or it's really 10%, or whatever. Well, it might be 15% in education, and it might be 26% in healthcare, but your Netflix subscription's not doing that. There's your car maybe is holding its value because you bought the right one. Like there's all kinds of different variables there. So I know where you're going with this, and I want to avoid oversimplifying it for the sake of trying to boil something down to a single number.
100%.
The other side of this, though, but sorry, before you keep going, the other side of this, though, is that the reason that we are stacking assets like stocks and Bitcoin is so that we can fund our lives in the future. Those assets benefit, in nominal terms at least, from this inflation that you're referring to. So when this new money comes into existence, when it's printed by the credit system of the banks and the Federal Reserve and the government deficits and all this kind of thing, that money has to go somewhere. And it does go into goods and services that pushes up the price and the production price of those things. It also goes into the assets that you're buying, that you're stacking over that time period when you're accumulating. And so you actually benefit from some of that money printing as long as you are actually putting that wind at your back instead of in your face.
So now let's bring in Bitcoin. A lot of people watching this use Bitcoin as their retirement plan. Well, you have the numbers, you've done all the spreadsheets, and you have some ways to progress out and look into the future and say, how much do you need to save? What can you withdraw? And how does Bitcoin change the whole equation?
So I think about Bitcoin's potential as one, asymmetric, that it can only go to zero, just like stocks can, but because of where it is in its adoption cycle and the fact that it's perfectly fixed in supply, it gives it an asymmetric upside that should produce, my expectation is that will produce a much larger growth rate than the stock market. To be very conservative, even though, over the past 8 years or something, it's been 50% per year on average or something like that. Right now, we're going through a period where if you look at the 5-year CAGR number, it's very small. It's still positive, but very small. But we need to zoom out and make sure that we're thinking about long enough time horizons where the actual economic and market cycles can play out over this. From a conservative standpoint, I tend to think about Bitcoin at a 25% CAGR over very long periods of time. If you drop that down even further to 20%, and you compare that 20% to a 10% growth in the S&P, which implies a 4% withdrawal rate, then I think you can apply an 8% withdrawal rate to Bitcoin. So this actually, I think, is very conservative. It sounds kind of crazy. Oh, you're going to sell down 8% of your Bitcoin every single year. But the math is the math. Those calculations work regardless of what the underlying asset actually is. If Bitcoin does actually produce those types of gains, it can sustain a higher growth rate. So the way that I apply this within the FireBTC Compass tool, that calculator that I referred to, is, as I mentioned, most people have a mix of stocks and Bitcoin. So if you apply the 4% rule to the stock portion or the non-BTC portion, and then you apply an 8% rule to the BTC portion, you're going to end up with some type of blended withdrawal rate that you can use as a baseline. And then the next question is, what is that withdrawal order? What should you be thinking about in terms of your plan when you start actually selling down that portfolio? Which asset should you sell first? Well, as I was explaining before, the way I approach it is you would sell down the stocks first and give Bitcoin a little bit more room to run. What that does is actually it actually expands that withdrawal rate, that blended withdrawal rate, a little bit more than that blended rate that you calculated, assuming you were drawing them down in a proportional manner. So there's a lot of little nuance here. People have a tendency to maybe get stuck in the weeds of these calculations. I'm definitely one of those people who likes the spreadsheets and all that. I would encourage you to resist that urge to a large degree. This is meant to be a foundational framework, guideposts, a wide ranging path to allow you to make plans that you otherwise might not be making, to open your aperture to the possibility that you can accelerate your path to financial independence by following these types of frameworks, and then give you some type of estimation ability, some tools for estimating when you actually will reach that number. And then when you do, you're at this point where you can start to open up that optionality that you've been going for.
How many apps does it take to manage your Bitcoin? One to buy, one to send, one for Lightning, and another for loans. That's a lot of friction. Well, now there's Rhino. Listen to the end, and I'll tell you how they'll set you up with $10 of free Bitcoin. Rhino is a next-generation Bitcoin app that makes living on Bitcoin easy. At Rhino, you can buy Bitcoin with zero fees. Get a Bitcoin-backed loan right in the app. Move cash globally over Bitcoin rails fast and easy. Automate your stacking with a DCA plan, so your stack is growing, whether the market is up, down, or you're touching grass. And it doesn't stop there. Bill pay, debit and credit cards, as well as retirement accounts are all coming soon. At Rhino, your Bitcoin is never rehypothecated. Security comes first, with biometric verification, 24/7 fraud protection, and the ability to move your Bitcoin to self-custody whenever you're ready. Click the link below in the description and download Rhino for iOS or Android. Use code BitcoinNews and Rhino will drop you $10 of free Bitcoin right into your wallet to start you on your stacking journey. Get the most Bitcoin for your dollar with Rhino. And so to integrate Bitcoin into your retirement plan, you highly advocate for a stacking sprint. You want to go as hard as humanly possible those first 4 years. Talk us through that and why that's so important.
This is the way that I approached my journey. I was following the FIRE methodology before I was really convicted with Bitcoin, and I actually started that stacking sprint using stocks primarily. I was still DCAing to Bitcoin. This was back in the 2016, 2017, 2018 days, but it was around that 18, 19 timeframe where I started, like, Bitcoin clicked for me, and I started to really understand that. And so all of the excess cash flow that I had up to that point was going towards stocks. All of the excess cash flow after that point was going toward Bitcoin, but I was extremely intent on moving past this phase of my life where I was chained to a desk and that I had to deal with that commute and that I was like dealing with all of the weirdness of corporate America. I don't have the experience of doing blue collar work, but I can imagine that grinds on you in a slightly different way, right? So this is not, dependent on the type of work necessarily. If you love what you're doing, by all means do that. I was not. I was ready to move on. I had a plan in place where, like, by 45, I was going to be completely done. I was going to play golf all day, every day. We're going to travel the world. I don't want to work at all. That's kind of changed for me, by the way. This is a little bit of an aside, just because I do love what I'm doing right now. Like, I work at a Bitcoin company, and I, love the work that I'm doing at FireBTC to kind of spread this knowledge here. So I'm not ever going to stop working altogether, but it's nice to be able to have that optionality for sure. The stacking sprint is a way to really focus and aggregate efforts when it has the biggest impact, which is in the early years of you pursuing something like this. So if you're starting from absolute zero and you go from 0 to 1 and then go from 1 to 2, in terms of, like, let's put it in Bitcoin terms. Let's say you stack your first 10 million sats, 0.1 BTC. That's kind of hard, but it's not that hard. I mean, it's what, $6,000 right now. Going from 0.1 to 0.2 is another $6,000. Most people can put that together in less than a year, if not much, much quicker than that. Going from 1 Bitcoin to 2 Bitcoin, which is the same doubling of your stack, is a lot harder. Now, all of a sudden, you've got to stack right now at current prices, another $60,000 worth. Well, the further out that you look at this, like the earlier stack, you have much greater impact on the growth of that portfolio. And this is before taking into account the fact that the price tends to go up fairly drastically over longer periods of time. So if you are going from 1 BTC to 2 BTC and the price is at 60,000, well, that's great. It costs you 60,000. What if the price has tripled and it's 180,000 all of a sudden, to go from 1 to 2? That's even harder and harder. So the idea is, I want to create this compounding engine. I want to create a portfolio that will work for me, that can replace my income. And the way that it does that is by getting as much in there as quickly as possible and allowing time to kind of do the rest. So by focusing on a stacking sprint, you front load a lot of that effort at the time period where it matters the most. And then you kind of get this snowball rolling for yourself, such that you can then pull off and kind of let off the gas, let the engine that you've built do most of the work for you. And then you could actually start to pull back on your contributions to your portfolio, because they're only helping a little bit at the margin at that point, because you've done so much work up front. And if you do nothing, if you get to a point where we call, like, coast fire, where your portfolio is big enough, over a certain period of time frame, I tend to think about this as like a 5-year period. If you've stacked enough and contribute 0 to that savings over the next 5 years, you'll reach that 25 times number without doing anything else, just from the sheer momentum that you've built in your portfolio. So this is the way that I like to think about the journey. And I think this works for a lot of people. Is you pursue this stacking sprint. It's 4 years of intense saving, doing everything you can to build that portfolio. And at the end of that 4 years, you can reassess, of course, but you can just pull back. reduce your DCA, start spending a little bit more, start building the muscles of spending, which is something that a lot of FIRE people don't do because they're so focused on the saving aspect. You actually have to learn how to spend if you've trained your brain to only be saving. And so this coasting period gives you an opportunity to kind of flex those muscles as well. So that's the way I like to pursue this. I think a lot of people can benefit from just having this defined period where they're just extremely intensely focused, and then it gives them the freedom to start to spend a little bit more later on in that journey.
And so part of the stacking sprint is it goes along with like a Bitcoin meme, right? Where you're selling everything, you're selling your chair, right? You're eating ramen, you're trying to save as much as possible to put it all into Bitcoin. Do you have any personal anecdotes from your own stacking sprint? And what tips do you have for those who want to cut back on expenses but don't really know what it would be most effective for them to do so?
Obviously, it's personal for everybody in different situations. My wife and I went down to one car for a time period because we were in a position where we didn't need to have the two cars. One of us, was at home most of the time. We didn't need to go in two different places. And so that's a real opportunity to save, what is a normal car payment? $3,000, $5,000, $1,000 a month, depending on what your actual cars are. And so that can be a really good way of funneling new money into your savings that you were otherwise spending, that you would otherwise be eating up by an expense. People like to kind of joke at like don't worry about cutting that coffee in the afternoon. I absolutely cut the coffee in the afternoon. And it's so incremental or whatever, but I was so focused on getting that compounding engine going as quickly as possible that I was like, I can give this up and put that like $4 a day toward Bitcoin instead of spending it on this thing. Is that going to have like a massive impact? No, but it did have a little bit of an impact, especially early on in that journey, right? If you're doing $4 a day, that's several $100s a year toward that $6,000 to get you from 0 to 0.1 BTC, which is like a really good way of kickstarting your stacking journey. So early on, that stuff absolutely does matter. Later on, it doesn't as much. And this is where you can kind of start to open up your freedom to spend a little bit more and then start to enjoy your life a little bit more.
And I've heard you talk about this in your videos, and you just alluded to it right here. But to get that spousal buy-in, right? To make sure that your spouse is on the same page as you and is committed to the same cause, because those first couple of years mean so much for your long-term plans. What kind of tips do you have to explaining this to your partner to make sure that you don't sound too crazy and that you can show them the light at the end of the tunnel?
It's not necessarily easy. A marriage is a negotiation, right? And just because I want to sell all of my stocks when Bitcoin is at 15,000 and buy Bitcoin doesn't mean that my wife is going to want to do the same. Women tend to have a different viewpoint on safety versus risk as well, relative to men, just generally speaking, right? And so there are all those different like psychological and emotional factors that play into that conversation. We've always been very open in talking about money. We talk about it a lot, kind of all the time. I think opening that communication channel is a really great way to just have you focus on something that is important to you. And so finding ways to have that conversation and bring her into your thought process, or bring him into your thought process, is a really great way to just move incrementally in the direction that you want to go. If you've got a healthy marriage and that open line of communication, typically speaking, you're going to have some success in being able to influence both of your thinking in a way that is constructive to the plans that you want. And it is a give and take, right? There's always a negotiation to be had. And I think that's important in any relationship, especially when you're talking about money.
And let's bring this back to the CAGR. This number is so important for all the calculations, especially the further out you get into the future. You use 25% as the annual growth rate for Bitcoin. I think a lot of the treasury company guys use 30%. But again, if you look back the last 4 or 5 years, that number shrinks a lot it just right now at this point in history. So how do you deal with that and the volatility? 25% CAGR looks great on paper, but as real Bitcoiners, we know the volatility can be very different when you're experiencing it yourself.
It definitely can. Volatility is something that cuts both ways. And when you're experiencing it, especially for the first time in Bitcoin, it can be gut-wrenching. You feel like your whole world is being turned upside down. It's almost like there are some people who start buying Bitcoin like near the bottom, and then the only thing they experience is a bull market. And then when that first terrible bear market comes to the fore, like it always will, they haven't had to deal with that volatility yet. And so in a lot of ways, it's almost better to, when you're starting your journey with Bitcoin, to have that baptism by fire where you're buying the top. And then as long as your conviction has grown to understanding that like there is so much value in this asset, especially over the long term, you're going to be buying all the way down and bringing your cost basis down and building that stack in a much more favorable environment early on in that journey. Volatility is also something that is not just relegated to Bitcoin. I think this is important for people to understand. I know we're looking at like a 5-year period where there's just meager returns point to point from the top to where we are now or something like that. Go back to 2008. It took 5 or 6 years for the S&P 500, which lost 66% from the top to the bottom there, to go all the way back and make a new all-time high. So if you were doing that same type of analysis, you would have the same type of criticism that, oh, this, look at this FIRE plan, it's never going to work because your assumptions for the growth rate of stocks is not holding up to the long-term average that you're basing your plan on. Well, what I would say to that is you're focused too short term. You need to focus much more broadly. Bitcoin doesn't have as much history as the stock market does in actual time, but it has more history in terms of actual trading time, which is a kind of an important stat. And we can theorize that based off of its characteristics and what we expect the world to become, that Bitcoin will play an increasingly important role. And because there is no supply function, that demand is going to continue to drive it further up. I kind of laid out the reasons where I think I can support, a 20 to 25% CAGR over a long period of time, but that long period of time piece is very important in the analysis.
And you prescribe a blended portfolio, Bitcoin and stocks.
Prescribe is way too strong of a word.
Okay.
I recognize the fact that most people are not 100% Bitcoin. I'm much closer to 100% than most people are, but I do have some stocks. And most people are not necessarily as convicted as you and I are. And they want to buy the SpaceX IPO and, take more of a traditional approach for a portion of their portfolio where they're just buying index funds. I think that's perfectly fine, to be honest. If you can develop a higher conviction in Bitcoin, then you're going to be much more willing and able and want to have a higher allocation to Bitcoin. This is not a prescription to say you should buy stocks or you should buy Bitcoin, but it's just recognizing the reality that most of us have a blended portfolio.
And one number that you've brought up, which seemed really powerful, is that for every additional 1% allocated to Bitcoin, increases portfolio returns by 9.6%. Walk us through that.
I did a analysis that was comparing various allocation percentages. This was a couple of years ago. So, obviously like the market moves and if you apply that same analysis, it's going to do something different. But various allocation percentages between the total stock market versus Bitcoin. And as you said, when you run the analysis across those different scenarios, it comes out to about a 9% extra return for every 1% allocation of Bitcoin that you put in your portfolio. Obviously, the 100% Bitcoin allocation outperforms stocks. You can see that very easily by looking at the S&P 500 denominated in Bitcoin over a long period of time. It just goes down and to the right. But actually running the analysis and seeing the numbers and how that might apply to a $100,000 investment or whatever you want to plug in there is very interesting and allows you to think about how that could apply to you based off of different allocation percentages that you might want to pursue.
And one benefit of the blended portfolio is that you have stocks, so you can sell them first, right? And you have time to let that Bitcoin compound. Let's talk about
it is a benefit, again, not a prescription.
Yeah.
And it's not necessarily a benefit that you should choose. I think if you are 100%, if you're starting from scratch, if I'm starting from scratch, I don't want to prescribe anything for anybody else, right? If I was starting from scratch, I would be 100% allocated to Bitcoin. It would be buying Bitcoin and Bitcoin only. I have these other stocks. I would want to sell those down first. So I'm not saying like you should buy stocks just so that you have something to sell down first for Bitcoin. If you have 100% Bitcoin portfolio, then you have no choice. But and my expectation is that you will still end up far wealthier than if you've got a mix. But again, just recognizing the reality that if you are assuming that you've got a mixed portfolio, then you need to make a decision as to which one you are going to start withdrawing from first.
And you have a particular interest in this subject. Were you always into money like this? Were you making spreadsheets when you were 12 years old with your paper route money?
A little bit. My dad was always interested in the stock market and has been, pretty successful in his investment strategies. I remember being, maybe like 6th, 7th grade, 8th grade, whatever, reading books about investing in stocks because I wanted to kind of follow in his footsteps. So I have always had some interest there, but life as a teenager gets in the way, and it wasn't really something that I focused on early enough. Like if I could go back knowing what I know now, I would 100% be doing that stacking sprint as soon as I started earning a paycheck and actually had some savings that I was building on a regular basis. I had my 401k going, but I wasn't maxing it out. That was basically the only like intentional saving that I was doing. And that's great. I was building some wealth, but I could have been doing a whole lot more that would have put me in a much, much different position right now. Those early years of stacking, for anybody who is younger and who's listening to this, those years in your 20s to your 30s, they are so impactful, and to the point where somebody who is saving a whole lot more but starting at age 35 will end up way less wealthy than somebody who is investing a whole lot less, but doing so with an extra 10 to 15 years of compounding. Like that compounding math is just so powerful. And it's something that if you can teach your kids anything, it is that the earlier, the better. As you get started earlier, you have so much more time to let that compounding engine work for you. And it is, the results of doing that are going to put you on a much, much better path in terms of reaching financial independence at a much earlier age, which is what I try to help my kids understand and help my readers understand how to do.
And a lot of people today, they're entering those working years in their 20s with a lot of student loan debt, right?
Yeah.
Debt in general. What's your ideas on the current state of debt in America, and how should people factor it into their FIRE plans?
We live in a debt-based economy, and that is a bad thing in a lot of ways, but it's also provides you with opportunity that other people don't have because they don't understand how it can be a tool in your arsenal. So I don't shy away from debt. There's obviously a difference between good debt and bad debt. If you are piling up credit card debt that is compounding at 25% per year, and you're just buying stocks with money that you're not using to pay your credit card bill, well, you're kind of working against yourself. Your debt, what you owe, your liabilities, is compounding faster than what your assets is doing. But if you flip those things, if you've got a 30-year mortgage, for example, at 6%, and you're making 10% in the stock market or 20% or 25% in Bitcoin, I think that is a really good trade. And a lot of people talk about paying down their mortgage, which I think is, at least today, given today's interest rate environment and that kind of thing, it's not the best idea, I think, for most people. It's certainly not something that I pursue. I think that the opportunity cost of locking wealth in the bricks and mortar of your home that you can't really access, that can't really contribute to your reaching financial independence because you can't draw down on it without borrowing against it or selling your home, I think that leaves a whole lot of wealth opportunity on the table. I would rather pay 6% on the mortgage and use the money that is not going extra toward the mortgage or being locked in that equity toward buying stocks and Bitcoin, and then making the delta. Does that require dealing with more volatility? Yes, of course. Are there risks to having debt at all? Absolutely. But let's go through it with a clear-headed view and not take this extreme approach to being totally anti-debt. And I've written quite a bit about this in the newsletter, so go check that stuff out.
In your newsletter and your YouTube channel, you're building a community here, and it's a combination of the Bitcoiners and the Fire community. What percentage would you say? Do you have more Bitcoiners in your community or more Fire proponents?
Oh, it's definitely more Bitcoiners, 100%. I think the two communities have synergies that they don't necessarily know about. And one of the main reasons that I write about this, one, because I enjoy it and it's a framework that has worked for me and I think can work for a lot of other people. But I think the Fire community has a lot of these frameworks that I've been describing here that could be very beneficial to Bitcoiners who are just solely focused on stacking and are not actually thinking about how that fits into their own financial plan. There's a meme out there, which I agree with emotionally and whatever, that like you can never have too much Bitcoin. I totally agree. You can never have enough Bitcoin. But the reality of the fact is that that's relative to what your actual goals are. If your goal is to retire early and you need that Bitcoin to be able to fund your lifestyle, then there is actually a point where you can have enough Bitcoin. And if you put a framework around there, you're gonna go forward in life knowing a whole lot more about yourself and give yourself a whole lot more opportunities than if you're just kind of stacking blindly. You may not know at all what that number is for yourself unless you go through this exercise. So I think the frameworks that the Fire community has provided, the way that they think about the world, the way that they focus on intentionality around spending and all of that is extremely helpful for people who are, one, trying to maximize their stack, but also just don't have a plan for themselves. And then, of course, the Fire community can benefit from understanding the asymmetric opportunity that is built into Bitcoin and being able to incorporate that into their plan, even if it is just 1%, 2%, 3%, or whatever. They can benefit from this asymmetric asset and the sovereignty benefits that you get when you are holding it directly. This is something else that we haven't talked at all about, but like Bitcoin provides sovereignty that the Fire community has never even thought about. Yeah. All of their wealth is locked up in brokerage accounts, sitting, in regulated, mediated financial institutions who maybe the risk of this to any individual is very, very small, but it's definitely not like zero risk. And if you are depending on the fiat financial system and the banking system and the brokerage system here for 100% of your wealth, I would say you're not at all diversified enough to guard against this potential outcome. And who knows what the geopolitical world is going to look like over the next 10 years, but it sure as hell doesn't look like things are calming down. I think it's going the opposite direction. Like things are getting crazier. And so I think it's worth it for the Fire community to take seriously the benefits that you get from holding Bitcoin directly, holding the keys to your Bitcoin directly, and bringing that into their portfolio so that they can build some resilience against that possible future and the different craziness that could play out over the world.
You stole the words right out of my mouth. I was going to go there next in terms of the fact that the FIRE movement, they seem to think that tomorrow is going to look like yesterday, right? That you have these returns that you can count on. Inflation's not going to get too out of hand, and that just as long as my spreadsheet is right, then my life is going to be good in 10, 20 years from now.
Whereas it's a very high trust view of the world, which, there's a lot of reason for that trust, especially as Americans. Most people don't have problems with the banking system or the financial system. They're able to easily move money. It works pretty well for them. Outside the US, that is a totally different thing. And I've written about this as well, is that, the FIRE movement has been very focused on the US. It's very US centric. And that's great for people who have access to the US stock market, which has outperformed relative to the rest of the world. But there are places in the world where they don't have access to the US stock market. They may not have access to any stock market at all. And so what option do they have if they're taking this type of view and they're looking to build wealth? They can't necessarily invest in their local stock market or their local assets because there's all kinds of other political risk there. There's much less opportunity for that economy to grow and the stock market that they might have access to actually compound on itself. But they do have access to Bitcoin. So Bitcoin can give these other people around the world who don't have this type of access that you and I enjoy a different option that they can use to actually start to build their savings and think about their life in a totally different way.
And I want to thank you for giving me a different perspective on the FIRE movement, because when I first heard about this, maybe a decade plus ago, it seemed like these guys, they're all kind of crazy. They're super frugal, right? They don't want to spend a dime. They'd rather live in a tent than actually enjoy any part of their life. But that's not necessarily true, right? I mean, you can either save a lot or you can also increase the ways in which you earn. Like, it's two sides of the same coin here. And so I think that the FIRE movement in general is sort of going through this revolution at the time, right? And one framing I really like is financial independence, recreational employment, not retire early, right? I mean, because especially a lot of Bitcoiners, like, you want to contribute, you want to give something to society throughout your whole entire life, and not just have this nest egg that you sit and hoard like Smeagol.
Yeah, I have a buddy named Kane McGukin. He actually did a guest post. I think I've only done one guest post on the newsletter. It was this one, because he reached out to me after I'd written something and he said, I think about retire as re-tire. I was like, come in and write this because I can't do a newsletter this week and I need to put something out there. And I thought that was such a great framing of the FIRE movement, which is that you don't have to retire, meaning like stop working, go play golf and sit on the beach all day. You can retire. You can change the treads on your car and move in a different direction. And the point of this movement is to get yourself into a position where you have that freedom. It's all about that optionality. It's all about that freedom. That's what I love about it. And that's what I think you should focus on. Some people, their dream life is to live in a, Sprinter van and go see the national parks and camp out or whatever. Like, they probably can retire on $20,000, $30,000 of expenses every year, and they're perfectly happy with that. If that's you, great. Me, I want the bigger house and a nice neighborhood with the pool in the backyard, like we were talking about before. I want to be able to travel and see the world. My conception of retirement is to be able to live a little bit more lush of a life than that, to enjoy all the same things that I can enjoy now with an income, but not have to have the working part of that. Mm-hmm. And so that's the way that I think about the expenses that I need to fund. I want to join a golf club when I actually have decided that I'm going to take some time, away from work. I want to be able to play golf on a much more regular basis. Well, that costs a little bit of money. So I should just work that into my plan. I should work that into the expenses that I anticipate that I need to cover. And all of these tools, this framework, gives you the ability to put this stuff in writing, put it down on paper, and think a little bit more thoughtfully about it, so that you can start working toward it and chipping away at it on a daily basis, on a weekly basis, on a monthly basis. And maybe you'll decide to do that stacking sprint so that you can just really, really go after it hard and get there as quickly as possible.
And yeah, money cannot buy you happiness, but it can give you a sense of comfort and security. And I think that that's really the core of this message, right? Like you're trying to get that foundation so that this life doesn't feel as crazy and out of control as it does for a lot of people who are living paycheck to paycheck and have no idea what they're going to do in their older years.
Yeah, money buys optionality, which in my mind allows you to have the option to be happy. You know, if you're totally starving on the street, I highly doubt people can, you know, look at that as a conception of happiness. But people are happy pursuing and doing different things. That's totally fine. Again, the whole idea is optionality and putting you in a position where, you know, there are a lot of people who have a lot of money, but you wouldn't necessarily think that they are happy, but that's not necessarily due to the fact that they have a lot of money. It's because of the way that they've configured their lives that has brought them that money. Maybe they're like working 100 hours a week and they're making $2 million a year or something like that. But they don't have any time to actually do the things that they enjoy or spend time with their kids. And so like there becomes a certain perspective that you need to take, which is like, you're right, money can't buy you happiness, but if you configure your life in a certain way, you can rearrange the deck chairs there and point things in the direction that you want them to go. You can take more control over how you spend your time, and hopefully from there, you can figure out how to buy that happiness indirectly.
And so to get started on this journey, you need tools, right? And the spreadsheet is your best friend in a lot of ways when you're going on this this planning route. But you also made the FireBTC Compass. Explain what this is and how you use it.
So I when I started out here, I built a spreadsheet. I was a bit of a spreadsheet jockey in my job at the bank that I was working at during this time. Very good at like programming and all of this. So I have this like complicated spreadsheet that I've maintained up to this day, and I update it, you know, at least a few times a week. I'm kind of crazy like that. You don't have to do that, by the way, if you're going on this. So you could check in once a week or once a month. It's totally fine. But you know, as I was talking about these concepts, I wanted to give other people something that they can use to figure out where they are on this journey, to be able to track their numbers over time, to be able to have those calculations kind of done for them so they don't have to think about how to build it on their own. And so that was the inspiration for the FireBTC Compass. You can go to calc.firebtc.io and it will bring you to this browser-based compass or tool. It will show you the 4% rule and the calculations from there. It will show you a Bitcoin adjusted number when you've got this blended portfolio or you've got Bitcoin in your portfolio. What does that do to the time frame and to the amount that you need to save if you've got this asset that grows a little bit more quickly? You can input all of your financial information in there in terms of assets, liabilities, income, and expenses at a very detailed level. There are some different like scenario analysis that I've started building out. One is called the bear market stress test. And it basically takes a look at your portfolio and it tests it against where the current price is right now versus if the last bear market from 2022 and the one from 2018 were to happen starting right now, and you get like basically another 75% drawdown, and what does that look like, and whether or not your portfolio can survive. So that's really cool. And I'm in the midst of doing releasing a feature I call Goal Seek, and this is really meant to drill down in a much deeper level on a lot of different questions, but the primary one being like, how much Bitcoin do you actually need to go? It's like setting an actual Bitcoin target for yourself. And when I release that, that's going to come with a kind of a paid tier feature. So all of my paid newsletter subscribers will get access to that. The way that I kind of think about the paid versus the free is finding out where you are and tracking that over time and having these calculations. Like that's always going to be free. It's something that I want all of my readers to be able to have access to. If you're taking the next step and thinking about these different scenario analysis and you're thinking about like what decisions can I make or what optionality does this open up for me? Well, that's something that a lot of the paid readers will find very beneficial, and that's something that will be unlocked through that paid subscription. So that's how I'm thinking about it. I'm always open to feedback, of course. And it's a really cool tool. I've gotten a lot of really great feedback. The last thing I'll say about it is that all of that financial data that you're inputting there, none of that data goes to a server. I don't see it. I can't access it. It's all done. Both the data storage and the calculations are all done in the browser. And so like it's a privacy first type of tool that creates obviously some friction in the way that I manage some of these things. And there's certain nuances to the way that that's implemented, but I wanted Bitcoiners specifically to feel very comfortable that they can actually put their real numbers in here and actually use the tool. And we Bitcoiners are very privacy focused, right? And so I wanted them to have a tool that they could use and feel comfortable with.
Well, Trey, it sounds like you're never going to retire. You're just going to teach people about retirement for the rest of your life. Thank you so much.
You build toward the optionality of doing the things you love to do, and I'm having a lot of fun.
Yeah, you're doing it. And it's been awesome to see your journey just over this last year, what you've built. It's super cool. And I think you are going to touch a lot of people and help them on this journey. So, Trey, thank you so much. If people want to learn more about you, the retirement work, your other full-time job, where should they go and what should they do?
Yeah, well, that's something we didn't talk about. I work at Unchained. I'm on the sales team over there, and we provide a range of financial services that starts with collaborative custody at the foundation, but you can buy and sell Bitcoin with us. We have commercial Bitcoin-backed loans, different account types like IRAs. And so definitely go check that out, unchained.com. You can schedule some free time with a member of our team to just understand what the options are and how we can help you with your Bitcoin journey there. For me, TreySellers.com is my personal website. FireBTC.io is the newsletter website. Calc.firebtc.io will get you directly to the calculator. And then you mentioned the YouTube channel. I've just started down that journey of trying to understand how YouTube works and get some interesting video content out there. And so just go search for my name on YouTube and you should be able to find that as well.
All right. Well, hopefully we helped some people get started on this FireBTC journey. All right, Trey. We'll definitely have you on in the future to check in and see what is new in the world of Fire. Thank you so much.
All right. Thanks for having me. It was great.
Thank you so much for making it to the end of this interview. If you are interested in building your whole entire financial life around Bitcoin, be sure to check out Rhino. They're the sponsor of the show and their link is down in the description. They are an all-in-one financial app based on Bitcoin. And if you want to keep going with the content, be sure to check out our latest interview with Tom Luongo. We discuss the Strait of Hormuz, the geopolitical situation, who the good guys are, who the bad guys are, and why Bitcoin is at the foundation of the world's next monetary order. See you in that one.